We're joined by Joe Lavorgna, along with Tobin and Marcus. Tobin, I'll start with you. It sounds like that's your line of caution there.
Yeah, look, deregulation has always been an important part of the policy mix. The President-elect Trump has been promising we're going to see broad-based deregulation with particular benefits for sectors like financials and energy. But when we think about pace, statutorily, generally, it's just as cumbersome to roll back regulations as it is to put them in place in the first place. So the same way that it took the Biden folks years to get some of these rules in place with the threat of litigation if they cut corners, I think the mirror image of that process is what some of the Trump appointees at agencies like EPA are going to be looking at. And if they do try and do a sort of big bang mass nullification of thousands of regulations, I think that's going to go straight to court, and I doubt that it's going to hold up.
Do you, Tobin, have a point of view on what's going on in the markets right now? What do you think it's telling us about the debt and deficit situation, if anything?
Well, look, I mean, the long-term debt and deficit situation is incredibly dire. I think that would have been the case no matter who won the election in November. And, when we look at the fiscal plans for this year, there's a lot of open questions. I tend to think that conservatives are going to push for some real spending cuts and pay-fors and offsets as part of this tax bill, but that's, sort of far from a settled question. And so, from a bond market perspective, I think it makes sense to be concerned. We don't think it's an acute crisis, but we've always expected some secular upward pressure on the long end of the yield curve. If you look at where term premiums are, that's the direction of movement we expected.
Joe, do you think it makes sense to be concerned?
About what, Kelly? The market?
No, that the market is concerned about the debt and deficit.
No, the market sold off for a couple of reasons. Number one, the Treasury made the imprudent decision to shorten the average maturity of the debt. So what we have now in January is the biggest rollover month of the calendar year. So the market's repricing a lot of supply and longer, and a lot more supply rather than will the rest of the year. Typically, seasonally, the first quarter is a difficult month. So that's one factor. It's a lot of supply. Second factor is term premium. Term premium has risen dramatically, and that's partly a function of the fact the Fed still has an easing bias. And the Fed itself imprudently eased rates both in November and December, which made no sense. So I think the market is adjusting to that. Once we get the Trump agenda in place, a combination of deregulation, lower corporate tax rates that increases the supply side of the economy, you'll have a stronger dollar, in part because I think growth prospects in the U.S. are going to be much better. That will cause inflation will come down, we'll have good growth, and you'll see market yields move back closer to 4%, which is where we put fundamental fair value.
I think, Joe, you and I would both concede that the economy's been stronger than we expected in recent months. I mean, I was sympathetic to the 50 basis point rate cut at the time, but then you looked, the market reaction was immediate. Immediately we started going the other way. And the data started turning. I mean, we erased any memory of that potential slowdown scare. Now we're in totally the other boat. And I'm curious there's going to be only one rate cut now this year, while you have Trump already talking about how rates are too high?
Well, I mean, look, the fact is the Fed did not need, they cut 50. I understand their rationale. I actually argued for 50, but they did not need to cut in November and in December. And the reason the economy has done well, in part, the Fed has fueled some real strong asset appreciation because they've kept rates lower than they should. So you've had the Fed ease rates with financial conditions super easy. That's one factor. But again, let's not forget the fact that the current administration has spent an inordinate amount of money in the economy. We've had 7 quarters in a row in which government-based GDP, if you want, it's a bit of an oxymoron, but government-based GDP has grown faster than private GDP. So that's one of the reasons why the economy has been stronger. And because the government's using so many resources, that at the margin has also helped push inflation higher. So if we could get the government at the margin out of the economy, it'll free up productive capacity, and you can have very much an environment as you had under Trump 1.0, where you had good growth, very good growth, and low inflation and low interest rates.
Right. We had rate cuts by 2019, Tobin, which, when we talk about the impact that tariffs may have, again, this time around, the sequencing could be a lot different. Back then, you had the big corporate tax cut first, then tariffs kind of slowly started to be applied. Now, both the size and the sequencing could be very different.
Well, yeah, and crucially, you don't have another 14 points to cut the corporate rate. I mean, President-elect Trump has talked about a conditional 15% corporate rate cut for domestic production. I think that would be nice for the companies that benefit from it, but it is of a very different scale than the corporate tax benefits that we saw the first time around. So, in terms of things to get the private sector going, obviously markets have reacted well to the prospect of deregulation, but we think that's going to play out over time. To the extent that we see spending cuts, we think they'll probably be backloaded. That's not something that's going to happen right away. Deficits aren't falling right away. So, I think when we think about problems like crowding out, I think those are going to be persistent problems. And then, looking through the course of the year, I tend to think that some of the bigger moves on tariffs, which obviously he has not made complete decisions about exactly what he'll do, but we think that'll probably take a little bit longer to play out than some people expect. Probably not going to see sort of massive worldwide tariffs on day one. If we do, that certainly would be a downside surprise from us.